Hi, and welcome to Sanford Advisor's Software and Internet Monthly Report for May 2023. As usual, we are going to review the previous month's M&A and venture capital activity across the entire technology landscape. So let's dive in on the M&A front. At a high level, we saw $4.8 billion in disclosed transaction value for a median revenue multiple of 3.3 times across 93 transactions for the month. This is the fourth month out of the last six where we have seen a lower level of transactions in the mid-90s and the third consecutive month of declining median valuations. As we'll expand upon further in later slides, the M&A markets are very much still open but continue to be selective. Despite being almost halfway through 2023, annualized figures for both the number of deals transacted and the dollars transacted is still lagging far behind the bull markets of 2021 and 2022, and is even off pace from pandemic levels. As we can see, strategic buyers continue to be the most active in the market, representing the buyers in over 65% of the transactions over the last 12 months. As mentioned earlier, we can see that the median valuation for software and SaaS transactions has continued to decline. We are on track for the third consecutive decline in both median valuations and the lower 25th percentile, despite the top 75th percentile remaining relatively stable and strong north of 8 times. This reiterates the selective nature and lower risk appetite for the current M&A market. More transactions are taking place at lower valuations, but for the right strategic deal, buyers are willing to pay up. We've mentioned this previously, but another interesting point can be seen through the spread of SaaS multiples and non-SaaS. Typically, the higher recurring nature of SaaS revenue has garnered a premium valuation. And while that is proving to still be correct, the spread between the two has almost vanished year to date. Non-SaaS companies tend to have slightly shorter break-even points and better cash flow, and we continue to see emphasis placed on profitability versus growth. This graph illustrates the point we made earlier, with transaction volume in the mid-90s for the fourth month out of the last six. Average volume across the last 6 months is also down 35% compared to the prior 6 months and over 50% from the same trailing 6 months last year. Switching gears to the venture capital side of things now, we are starting to see a return in the overall VC market from a volume perspective, with another month-over-month increase in 456 transactions in May. Dollars invested for the month was up significantly at $11.5 billion. However, the vast majority of this was driven by the previously announced $6.9 billion raise from Stripe, which was a non-growth oriented investment round at 2.5 times valuation. If you exclude Stripe, the VC market is starting to show some small signs of recovery, but it would be interesting to see if that continues throughout the year. Moving to monthly VC deal counts, as mentioned, we have had back-to-back months of increased transaction volume, and we are meaningfully above the 24-month low we saw in March. It was great to see that the early and mid-stage volume was helping to drive some of this recovery too. But as we look at annualized deal volume and dollars invested, we are still well below the historical averages for deal volume. The dollars invested look better on the surface, but Stripe and its $6.9 billion raise represent approximately 19% of the year-to-date dollars, so the data is a bit skewed. As noted in prior months, we continue to see an interesting trend with the inverse of early stage valuations relative to mid and late. If this early indicator of recovery continues, we could see prolonged activity and improved valuations throughout the remainder of the year for the VC market. It'll be interesting to see what indicators the Fed gives on the overall economy during its June meeting. And with that, we conclude this month's review of the software and internet M&A and VC market update. As always, thanks for listening, and we hope to see you next month.